Most people think they have two choices with their money: spend it all today, or lock it away in a bank account and watch inflation eat it alive. Both choices keep you broke. But there is a third option that the wealthy use to buy back their time. It is called investing, and it is not about timing the stock market or finding the next cryptocurrency that will crash tomorrow. Investing is simply buying an asset today that will pay you more money tomorrow. When you buy a stock, you aren't gambling. You are buying a tiny piece of a real business, like Apple, Microsoft, or Coca-Cola. When those companies make a profit, you make a profit. You don't need thousands of dollars to start. You can start with just $10. But before you buy your first stock, you need to understand the magic math trick that turns small change into millions. If you invest $300 a month starting at age 20, you will hit retirement with over $1 million. If you wait until age 30 to start investing the exact same amount, you will finish with less than half of that. Why? Because you missed out on the closest thing to real magic in finance. It's called compound interest. Albert Einstein supposedly called it the eighth wonder of the world. Here's how it works. You invest money, and that money earns interest. Then, in the next year, you earn interest on your original money plus the interest you just made. It creates a snowball effect. In the beginning, the growth looks tiny. But after 10, 15, or 20 years, the snowball becomes an avalanche of passive income. Time is your greatest leverage, not the amount of money you have. But how do you actually pick what to buy without losing everything? That is where the ultimate lazy investing strategy comes in. 90% of professional money managers, people with degrees from Harvard and Wall Street budgets, fail to beat a basic, lazy investment strategy that anyone can set up in 5 minutes from their phone. Here is what they don't want you to know. Instead of trying to guess which single company stock will go up, you should buy an index fund or an ETF, like one that tracks the S&P 500. This is a single basket that contains the 500 biggest, most successful companies in America. When you buy one share of an S&P 500 ETF, you instantly own a tiny piece of Google, Amazon, Tesla, and Nvidia all at once. If one company fails, the other 499 carry you forward. Historically, this basket has returned an average of about 10% per year over the long term. It is the ultimate set it and forget it wealth builder. But none of this works if you make the #1 psychological mistake that ruins beginner investors. The stock market is the only market in the world where people run out of the store screaming when there is a 20% off sale. When stock prices drop, beginners panic and sell everything. This is exactly how you lose your hard-earned money. True investing is a game of psychology, not math. Markets fluctuate. Prices go up and prices crash. Red days are completely normal. Successful investors look at stock market drops as a discount season. They don't sell. They buy more shares while they are cheap. If you cannot look at your account dropping by 15% without panicking and hitting the sell button, you aren't ready to invest yet. Wealth is built by buying consistently, every single month, whether the market is up or down. If you automate your investments into broad index funds and zoom out for the next decade, financial freedom isn't a hope. It's just math.